All right. We are live on Tuesday, December 7th. No, yeah, December 7th, right? And
December 7th. Yep.
Pearl Harbor Day.
Yeah.
Um, Another crazy day in Lumberland. Seems like the new norm is crazy. Can you imagine how bored we're
Uh,
going to be if we have small ranges?
yeah. Yeah. And this is not for the faint of heart, that's for sure. And not just lumber. Equities, Dow's up almost over 1,200 points in the pretty much last 24 hours, a little over that. Crude's up almost $7 off of its Friday's low. So there's just volatility all around us right now.
What do you equate the move in crude to?
I think two things. Equities and crude. You have the new variant, Omicron, and I think there was an overreaction that they're going to go to more shutdowns, and as actual news facts come out surrounding it, risk off, risk back on. Goldman put out something yesterday that the move in energies was completely way overdone. Nothing has changed as far as the fundamentals of what they see, and I think that kind of ignited the risk back on where whomever got pushed out, muscled out last week on the volatility to the downside, it seems to be flowing back in, put everything back on. So it's pretty amazing to watch the volatility, not just in lumber but in all these different markets.
It is. You know, it says to me that people are so nervous they're just not really even participating. It's the
Yeah,
walls aren't
no,
to contain it.
yeah, no, I mean, we can get into what we think of the Fed and Fed policy, but at the very least, I don't think anybody is going to disagree in that you basically are facilitating flight to quality into risk assets. Risk assets return some. You get a return on your initial cash investment. You're not getting a return anywhere else, so you're just pushing people into assets that give you a return. And whether you believe in it or not, that's kind of what's dictating where people put cash. Where just when you look at the increase in inflation here, sitting in cash, you're losing out. You can argue, okay, inflation's transitory, but if you look at inflation year over year and you're sitting in cash, you would have lost 4% instead of gaining the 12, 15, 18% in equity. So that's those are real numbers here. You might not agree with policy, or you might be on one side of the aisle or the other, but that's the known quantities here. That if you're in cash right now, you're losing out.
So let's jump to lumber. What
Let's
is
do it.
going on?
Ah, if we could figure that out, life would be a lot easier. Let me jump. We'll jump right into it here. Here's a January chart, and instead of just toggling back and forth, I just basically updated. This is live. This is as of today's high. January traded up to 977.50. So November expiration, we had this bottoming formation, and you can see how we've just exploded higher here, where when you take the lows of 618 from basically the day before November expiration, we're up 58% off the lows. We've had basically a $360 move off the lows in 2 weeks.
Yeah, it's and there was Thanksgiving holiday in there, so
Yeah,
really,
yeah. No, it's truly amazing. So when we look at the basis, Um, amazingly enough, here a week ago, basis was around $125. Cash under January futures. Flip to today, and this was as of yesterday's close. We were $171. If you want to look at the intraday highs today at 977.50, you are well over 200, 215, almost $230 on an intraday basis point, on an intraday point in time with today's basis, January over physical cash. I know West Fraser's the low man on the totem pole at 760. They came on this morning, not really showing cars, not really showing trucks. Everybody else is scattered in this 800 to 850, 900 areas. So, if you ask people where is physical cash today on 4-inch and 6-inch, I don't think you're going to get clarity on an answer where, it's, I think everybody's literally making numbers up 2 or 3 times in any, at any given point during the day right now.
Yeah, there's no doubt searching for market trading levels. Um, we've seen and heard prices kind of all over the place. I find. Do you know what West Fraser's order file is right now?
They were quoting the week of 1.3, 1.10, depending on the item. And again, that's if they're not showing cars, they're showing a random car to A-list distribution. Everybody else is, if we had trucks, we don't have trucks. So where mills are coming online. But if you're, especially if you're a wholesaler, wholesale brokerage type operation, you're not even seeing list, or you might see a list and it's like, okay, if we had the cash, this is where we'd be. We don't have the cash.
Interesting. Um, let's move on to the next
So
basis.
here's March, and Joe, just quickly with this, March is up $305 or up 48%. So again, we'll get into, January is up harder than March. Obviously that makes sense because January is closer to physical cash. People need that prompt wood. And if you look at basis here, there's really not a big change in the week over to week basis chart. You're still in that 123 to $140 area. And then here's that Jan-March spread. Again, November expiration, that spread was 20 under. The high water mark so far this week, we actually today, since I printed this out, we've traded as high as 42.40 on this spread right now. So January is trading 42.40 over March. So that explains January being up 58% off of its lows, March being up 48%. You're getting more bang for your buck to the upside in January.
Yeah, and when the spread is the front month premium, it's telling you that people want wood now.
Yeah, absolutely. This is more indicative of a bull market, a front spread bull market structure where this at least kind of makes sense in a market that's explosive like this, where you're up 350 plus dollars. January, the front month should be leading the charge, and everything else should stair step down. Let's see here. So here's the daily continuation chart. The one thing I wanted to point out here, I know people always talk about the Fibonacci retracement numbers, and this is just a technical analysis that takes the highs and the lows, and markets tend to gravitate in these percent moves. So if you just take all-time highs, the all-time lows on a continuation chart, you're basically above the 38% retracement. 50% retracement is in this 1075 area. So, somewhere in this today's high 977 up into this 1075 area, technically that's kind of the projection on where we're headed in the front month right now.
Yep, and historically, lumber really likes 50% retracements.
Yeah, yeah.
Look, I can't give you any logical, any scientific, any reason other than that. In my experience, I've watched lumber do 50% retracement. So yeah, when we kind of broke out of the highs, a week or so ago, I kind of, that's the first analysis I did, is what was the halfway between the last big move. The other thing that comes to mind too is there always seems to be an aftershock on a massive move. When you go back to the early 90s, is that when the spotted owl was?
I think 92, 91, 92 in that time frame, 93, somewhere in that range.
Right. It shot up came back down, shot up a second time, doesn't go as high, and came back down. The 2018 move, we had two shots up. When was the early 2000s? Wasn't there? There was kind of a double shot in the early
Yeah,
2000s.
yeah. Yeah, you had just ahead of when housing peaked out, you had a big move in 2000, I think 2003 into 2004. So yeah, no, lumber again, if you like volatility, then this is a market that and I was literally on the phone probably 10 minutes before this call, and I had somebody buy, and oh gee, I bought too soon because the market, we raced up to 977.50 today, started to fall back. January fell back to 970, basically $900, and within a blink of an eye, you were back above 953. Where when you take the 977 down to 900, back up to 962, that's a pretty, when you just add those ranges up on an intraday basis, that's just a massive trading range for a market like this.
It
You
is.
know,
It's it. Yes, it can be a little overwhelming. I'm looking at what I find kind of fascinating is the volatility implied by options. It's it's kind of been steady for the last, even since that big run up in the spring. We volatility went up, but it's just stayed there.
yeah, and I will say in writing call options, you're really not seeing these dramatic spikes. We've had a lot of limit up moves, obviously here, but from an option pricing standpoint versus when we did this the first time last spring, even a year ago, and again, this is just my analysis in writing a lot of different options, calls, and puts. You're not collecting nearly as much on the call side, where you're having to do a lot more work to get paid bigger premiums on the call side on this move higher right now.
Excellent. All right, should we roll into what you got
I'm going to
next?
do, let me see here. I'm going to do just run through open interest. I just want to point something out with open interest in the CFTC numbers, and then we'll jump into options here.
Perfect.
So a week ago, we were around 1883. This morning, we were up over 2117. So the good news is we continue to build open interest. Off the low water mark, we were in that 1400 area. Now we're up over 2100. That's great. You should be building open interest in a bull market structure. The one thing that stood out with the CFTC numbers, this was as of the 23rd. So that week prior, you had a big increase in managed money in the commodity fund longs. So, momentum trading, guys chasing the momentum higher in lumber. And the expectation was, with this continued build in open interest, that you would see another big spike in the managed money component. And when you look at the most recent CFTC numbers, you got zero traction. You actually lost some contracts with managed money longs. So the increase in open interest was the result of producers, basis hedgers adding to their short position to capture the historical basis. And then also these non-reportables, these are the small speculative element, kind of liquidating shorts, chasing momentum higher. So I'll go back here, but you can see open interest. We're finally we're finally above this 2000 area now. Let me go back here one. So again, with the CFTC numbers, instead of the funds increasing their longs, you had the small speculative crowd increasing. The thing that I don't like about this, Mike, is I call this the last in, first out type crowd, where this is usually 1 to 5 lot traders. It could be industry related. It could be non-industry related. It's everybody that doesn't basically fit the CFD's definition of a reportable position. So these are small positions, but from a margin call standpoint, when the market momentum stalls out, these guys are the first to get liquidated out of the market. Once the market reverses course and the momentum goes in the opposite direction, you will see this component right here liquidate first. So that's something to watch. Unfortunately, for whatever reason, the fund stopped buying here, and the momentum, it was picked up by these guys, but these guys are, this long component here has much more staying power from a margin call standpoint. They usually have much bigger pain thresholds. This crowd right here, when the momentum shifts, this is usually who's going to cause it first. So something to watch.
Yeah. So, I'm seeing there were a lot of indicators last week to strengthen the market. This week, I don't think we have the indicators that would, make you want to pound your fist on the table bullish. But by no means do we see any indicators that the move has, come to an end.
No, and I agree. I think the one thing with futures, yesterday's limit up move, initially you did it on very, very light volume, probably in the neighborhood of 45 to 50 contracts in January to go limit up. I mean, total volume yesterday, you only traded collectively 167 contracts. You only traded 102 in the front month. When you strip out those Jan-March spreads, you traded less than 90 times outright in the front month. I understand the market was limit up, but that just to me goes to show that there's more fear in selling, and the buying at these premiums to cash isn't that obvious for commodity funds, for large volume type traders. It's not that obvious just to chase pure strength at this kind of detachment from cash, where, at the end of the day, cash is probably still your better buy. Even though we've seen significant appreciation, you probably still want to buy the cheapest wood out there, which is physical cash. And then if there's any risk, then you look at futures on the sell side from an inventory hedge standpoint, from a production hedge standpoint. But I'm just going to forewarn, I understand the market can go higher here, but given these premiums and futures, you're not going to be at $150 to $200 premium in futures, at least in January, 2 to 3 weeks from now. You're not going to carry this kind of premium going into the end of this month, going into the spot month. So either cash is going to go parabolic to narrow this basis, or futures is going to give something up or at least go sideways as cash plays catch up. And I look at today, this attempted correction lower as the shot across the bow, that it's not that obvious at these kind of premiums that, look, if cash is going to $1,000, $1,200, then you can continue to push futures. But the second cash has any stalling out, then be very careful on the long side of futures, especially at this historical basis, in futures over cash.
Now, another kind of counter to that, though, is I'd like to point out the basis traders, if they want to roll their short position right now, they're taking it on the chin. So
Yeah. No, and so to play devil's advocate and kind of go along with what you're saying, a year ago, this Jan-March spread, we talk about the difference between Jan and March. That spread was somewhere in the $38 to $50 area. By the time you got into the first week of January, that Jan-March spread went 150, it went $200 January over March. So, I guess it all, what side do you fall on? Is this a repeat of last year? If it's a repeat of last year, then you can get very exaggerated, painful rolls if you're short. Or is this a repeat of the last two contracts where we ultimately top out? The expectation is that convergence takes place with cash running up to futures. The last two contracts, futures collapse down into cash. So there are both sides of this. And again, the last thing, and I know we're getting sidetracked a little bit here, but from a basis standpoint, again, pure basis, all you care about is the convergence. You're not
correct.
speculating one side has to take place versus the other. I can tell you that by the time you get into the end of this month, into the spot month, you're going to get convergence much more significant than $150 to $200 over. You're going to be sub 100. You're going to be sub 50. One way or the other, the convergence will play out. And again, that's the speculation element: is cash has to go up or futures has to go down. We
And
don't know. Yeah,
the challenge for every basis trader is exiting the position. It's
yeah,
pretty easy.
exactly.
It's easy to put the position on. It's the getting out of the position that takes the real art and skill, I guess you could call it.
Yeah, yeah, exactly. So again, sorry we got sidetracked here.
No problem.
Let's. So we talked about. I'm going to try to. We'll kind of rehash this a little bit. So we talked about options last week. A call contains the right, but not the obligation to buy something. A put contains the right to sell, but not the obligation to sell. Again, this is on the buy side of an option. If I'm buying a put, we talked about if I'm buying a put, I want to put the market down. I think the market's going to go lower. If I'm buying a call, I'm calling up. I think the market's going to go higher. So people that bought calls ahead of this are being handsomely rewarded. People that bought puts, well, it's not doing what you thought it would do. But again, if you're buying an option, your risk is your risk is defined on what the premium is, what you're buying the option for.
All right. Well, let's talk a quick little bit of strategy on who would buy a call, who would buy a put, and this market move that we just had. It really explains why you would want to do that. So
Yep.
let's say you're a builder and you need material for Q1, let's say starting in March. But you don't want to get into the futures market because maybe the margins requirement is more than what you can stomach or that your organization is ready for. You can buy that call. You can buy the right to buy, and you lay out. You know exactly what you're going to lay out. That money is gone, but you have the right to enter into that long position. If the market blasts higher like it has done, you're protected. Now, if the market drops, now you have opportunity to let the call expire worthless and buy your cash, buy lumber cheaper.
Yeah, and I'll say I see this with private equity and the home builder types, Mike, is that okay, look, in this under this current structure with cash and futures, you're not being rewarded to buy the premium in futures. And from a physical cash standpoint, look, I only have so much cash. I can't accumulate the next 9 months of physical inventory. I don't have the storage capability. The guys, the wholesalers, the dealers that I buy from aren't in a position to do that, where I don't want to pay these elevated prices in futures and then have to margin it and deal with the volatility. This is the perfect idea of buying a call, again, which is basically you're buying an insurance premium to the what if scenario where by the time I actually need to buy this wood, let's say I'm going to have to buy it in February for March delivery, or in March for April delivery, the height, when your traditional building season kicks off in the Midwest, the Northeast, this is where a call option. And we're not asking, look, I might buy an in the money call. There might be a premium attached. I'm gonna have to pay $50, $70, $1,000, but I build it into the cost of my contract and quoting these jobs out. It's the cost of doing business, but it's that insurance policy on the what if scenario. What if lumber goes from 550 to 950? Then at the very least, I've covered a large percent of that move, and I absorbed that price impact and having to go buy those high priced contract, the actual physical cars of cash at these high priced levels. And sure enough, we just spun out of that scenario where the expectation, okay, November futures went off weak at $566. Cash is weakening. You get the flooding in BC. We're off to the races here. So obviously spending that $30 $1,000, $50 $1,000, whatever the money was, would have paid off handsomely here as far as absorbing this volatility to the upside.
No doubt. And now the same story in reverse for buying the put. If you have an inventory of lumber and you want to protect that price that you've bought at from a downside risk, you buy the put. And in this case, it you'd be actually pretty happy right now that you bought a put instead of actually putting a short hedge on in futures
Yeah,
because
and this is a great example, and this is something that is being executed over the last week, Mike. Is that you have the luxury of buying put options now. Whether you're looking at January, you have 24 days to expiration, or you go out to the serial month of February, or you go out to March. So February options go off in 55 days, the end of January. March options go off the end of February. You've got 83 days to expiration. But the point is, you're able to buy put options equal to the discount of where physical cash is trading. So if you don't want to sell futures because you don't want to have to margin call something like, what if we repeat last year? I don't want to have to margin call a move $300 to $500 higher from these levels. Well, the put is defined risk, and I have the luxury in this type of basis structure with futures trading at a premium. I can buy relatively high strike prices within a higher degree, a higher percent closer to where the underlying market is. And there's going to be a cash outlay associated with it, but it's going to give you, in the event cash does not appreciate up into futures, we know that if and when this market sells off, with the basis that we have in futures, well, you're buying strike prices, you're buying put protection at realistic strike price levels that are going to help protect your physical inventory.
that's uh that's really interesting. If you think, I just want to make sure everybody understood what you just said. Futures is up here, where you could sell cash is probably down here. The difference between those two prices is relatively close to the cost of buying a put for that same price. So,
Yeah.
I can look real quick to give an idea of what the put. Let's see, 955 Jan puts are, probably it would take about $65 to buy one of them. So that's right under $900. And you're saying, what are we saying the cash price is today?
I think conservatively, cash is probably somewhere in the 8 to 850. I mean, I've heard upwards of 875 to 900, but I think there's a wide degree of error there as far as, let's say somewhere, just average it out. Let's say 825 to 850, 875 would be my guess.
Yeah, so there you have it. You can actually sell the market safely, better than cash, using put options right now.
Yeah, absolutely. Absolutely. And you do have people, again, that don't want the margin call exposure where, well, what if the market goes higher? What if we repeat last year? This is defined risk where whatever I'm going to spend on this put option, that's the most I can lose. There's the cash outlay up front. They debit your account. The CME, your clearinghouse, will debit the money up front. That's it. That's the most you can lose. So at the end of this trade, if cash goes to 1200, then that's just the put premium is what you can lose, and that's it. If the market sells off, then I'm not going to say you're going to capture dollar for dollar unless you go under that strike price. Again, there's some nuances there that we'll get into in another one of these podcasts on time decay and what constitutes going into how options are priced and how volatility influences the pricing. But this is, in its purest form, this is a perfect real-time example of buying calls or buying puts, why both sides could justify buying calls, why the other side could justify buying a put. and the volatility is unlikely to go away anytime soon. So, at the very least, I think people, if you're not going to do this, at least begin to understand how you can use futures without the outright exposure of being in just outright futures.
And actually, Greg, I'm so glad you just said that. When you buy an option, what you are buying is protection from the volatility.
Yep.
So we've just laid out the case, a rising market where both the buyer of the call and the buyer of the put have benefited by entering into that position. And it's because the market moved so fast and so violently. It was a very volatile market that by having an option on, you did better than just having outright futures. So that's
Yeah.
I
You
think
laid it out perfectly, Mike.
it's I think, you know what, we're 30 minutes into this. Let's leave everybody with that. I think that's an important concept. I do want to talk about selling options, and I think we'll cover that next week. But the reason to use an option from the long side by buying an option is to protect yourself from volatility, from protecting yourself from an explosion of volatility or more volatility than you're ready for, or that basically volatility helped you on that.
Yeah, and the one thing I'll add, Mike, as we progress through options, we'll definitely try to provide real world, real time examples of why somebody would be on both sides of the trade. So next week we'll cover why somebody would be writing the option, but I think that's going to help people kind of understand options and how the mechanics of options work with real-time examples. And the great news is we've got a market that provides lots of real-time examples in any given week. So
Yeah, can you imagine if we had to try to do this with a flat market? It would be pretty darn boring.
yeah, no, I think this is going to be a good thing moving forward, and I appreciate the time, and we'll pick right up from at this point next week for sure.
Yeah, and I know we have up there ask questions at any time. Um, that means anytime, even off the call. If you want, reach out to Greg Kuta. He will walk you through, talk to you about your business and talk to you about how you could use futures to enhance your return or protect your investments. You can reach out to me at any time as well. I'd be more than happy to talk to you about the dynamics of how the lumber futures and options market work. With that, we're going to sign off. We'll check in with everybody next Tuesday. If anyone on the call is going to be at the Northeast Retail Lumber Association dealer show, I'm going to be out there. I get on a flight tonight to Rhode Island. I'll be there Wednesday and Thursday. Come by our booth and say hello. But other than that, safe trading. Good luck, and we'll see you next week.
Thanks, Mike. Thanks, everybody.
Take care, Greg.